All right, welcome to this week's Simple Market and Economic Update. My name is Jason Hamilton, the founder of Keep It Simple Financial Planning. And as we begin the second half of the year, we're going to talk about 5 key themes that investors should be aware of. Through the first 2 quarters of the year, the S&P 500 has gained about 15% as tech stocks and the possibility of Fed rate cuts have propelled the market to new all-time highs. Improving inflation is also slowly beginning to support the bond market and sets up the possibility that the Fed could cut rates 1 or 2 times later this year. However, many investors are still nervous about the market outlook and are waiting on the sidelines, holding on to cash and maybe too much cash. Perhaps the biggest event in the second half of the year will be the upcoming presidential election, especially the impact that it may have on taxes, inflation, regulatory policy, trade, and more. So over the next few minutes, we're going to touch on these themes and discuss their importance for investors to maintain a perspective on the overall next several months. So let's get started. Right, first, the market has experienced a very strong rally this year, with the S&P 500 reaching over 30 new all-time highs. Continued optimism over tech and AI-related stocks has helped to drive this rally, and this may come as a surprise to some investors since there continues to be significant market and economic uncertainty, and some investors may worry that the market hitting new highs could be a sign that the market is quote-unquote due for a pullback. However, since markets tend to rise over time, it's natural that the markets can hit new all-time highs very regularly, especially during bull markets. So investors who worry too much about the exact level and try to time the market may miss out on long-term performance. History has shown us that it's often better to stay invested and focus on the long-term trends rather than day-to-day headlines. So what I recommend is you have an investment schedule and an investment process that you stick to. And that might be investing once a month. It could be every 2 weeks. Whatever it is for you, that you set that up and you just commit to that regardless of what's going on in the markets. If you do that, you're going to be a lot more successful long-term. Second, the Fed is expected to start cutting policy rates later this year. These expectations have changed significantly with the timing of the first rate cut pushed back after repeatedly higher than expected inflation readings. But the most recent data show that inflation is finally easing. Most recently, both the Consumer Price Index and the Fed's preferred measure of inflation, the PCE Price Index, showed that prices were flat over the month of May. So this chart shows the current level of the federal funds rate alongside the Fed's rate projections for the coming years. Their latest projections suggest that there will be 1 rate cut this year, while markets anticipate between 1 and 2. While it's difficult to say, history suggests that a decline in interest rates alongside falling inflation and a strong economy could help to support the market rally that has occurred in the first 2 quarters of the year. Third, this chart shows how bond market sectors have performed each year since 2008. Each column represents a different year, with the bond market sectors ordered from best performing at the top to worst performing at the bottom. On the right, you can see that the Bloomberg U.S. Aggregate Bond Index, also known as the AGG, is now flat on the year after struggling through April due to worse than expected inflation in the first few months of 2024, which pushed bond prices lower. Improving inflation doesn't necessarily mean prices will fall for all goods and services, but it does show that we are returning to a more normal environment, a good sign for markets and a harbinger of Fed rate cuts. Since lower interest rates boost bond prices, this has led to improvements in many parts of the bond market, such as investment grade and high yield bonds. Next, generating income from safe investments was a major challenge for investors from the 2008 financial crisis until only recently. If you remember, we were getting 1% on a high yield account, and now we're over 5% in many accounts. So this is why many investors are taking advantage of the higher cash yields today. However, there are 2 challenges with this. First, many cash yields are still not outpacing inflation. So this means that while investors are receiving interest income, the purchasing power of their cash is still being eroded. Cash on its own cannot make up for inflation, which is why stocks and bonds are needed for long-term portfolio growth. Second, the amount of cash that investors hold has increased dramatically. This may be related to fear around the markets being at all-time highs. The challenge with waiting until interest rates decline to get back into the market is that both stocks and bonds tend to rally quickly when this occurs, making the timing incredibly tricky. This is yet another reason that it's often simply best to just stay invested and stay diversified. Right, finally, some investors may be worried about the approaching presidential election, wondering what it could mean for the country and their portfolios. While elections are incredibly important as taxpayers, citizens, and voters, the impact on markets can be counterintuitive. When it comes down to it, financial markets have performed well across both parties over the past century, as shown in this chart. This is because the business cycle and the many factors that drive economic growth are far more important than who happens to be in the White House. This is not to say that policies don't matter, but the changes tend to be incremental and take time to impact the businesses and consumers. This chart shows that from an investment perspective, it's important not to overreact to the outcome of an election or poll results when it comes to our portfolios. So amidst market all-time highs, slowing inflation, and the possibility of lower interest rates on the horizon, it's important for investors to stay focused and stick to their long-term financial plans. We hope you found these insights helpful. If you do have specific financial concerns ahead of the election or throughout the second half of the year, please don't hesitate to reach out. We look forward to speaking with you. To wrap up here, my name is Jason Hamilton, the founder of Keep It Simple Financial Planning. And if you'd like to speak with us and discuss more about your investment portfolio, your retirement plan, or anything in the financial realm, we'd be happy to speak with you. You can go to keepitsimplefinancial.com/talk to schedule a meeting, and we'll look forward to chatting with you then. Have a great day.